Getting back to equities, and as we told you, it is the start of the second quarter earnings season, and we will get to hear from IT major TCS today. And of course, there will be a lot of excitement around the buyback for sure. But Rima, purely in terms of numbers and the performance, what should one expect in Q2?
Well, we are expecting a very good quarter. In fact, the market positioning also seems to suggest that, the market is pricing it a very good recovery on a quarter-on-quarter basis, close to about 3%, a buyback to the tune of close to about $2.5 billion. And TCS earnings are important. For one, it has a weightage of nearly 5% on the Nifty. And while the stock has outperformed the Nifty, it has underperformed the Nifty IT. So far on a year-to-date basis, TCS has rallied 25% vis-a-vis an Infosys, which has moved up 45%. But if you compare it to the Nifty or the Sensex, there is a serious outperformance. However, just in the near term, ever since HCL Technology came out with the mid-quarter, guidance update, TCS has actually outperformed the rest of the pack with a gain of close to about 15% But as I said, we are expecting a good quarter, a recovery of nearly 4.5% on a quarter-on-quarter basis in dollar terms. In constant currency, it should be a revenue recovery of close to about 3%. Margins likely to bounce back closer to the 25% mark. In management commentary, the key is going to be the sustainability of this strength. How durable is the recovery in growth? Can it extend till FY23? Let's pose all these questions to an expert. Sandip Agarwal of Edelweiss Securities now joins in. Sandip, first, if you could run us through your key expectations from TCS in terms of revenue, margins, as well as buyback.
So, thanks. We are expecting a 5% dollar growth and 3.2% constant currency growth, and EBITDA margin of 27.4% and EBIT margin of 25.6%, which is a 200 basis point expansion versus last quarter. In INR terms, we are expecting 39,462 crore revenue, which is up 3% quarter on quarter, and 10,830 crore EBITDA, which is up 8% quarter on quarter, and a EBIT of 10,120 crore, which is up 12% quarter on quarter, and a PAT of 8,217 crore, which is up 17% quarter on quarter. So very robust number we are expecting, without doubt. We are also expecting a good buyback around $2.5-3 billion, and generally we have seen TCS comes out with a 20% kind of premium to the CMP for buyback. So I expect around 3,100 to be the price where the buyback should come. But more importantly, I think the order book will be highest in the history for sure, and the commentary will be good. Although, a very bullish structural commentary probably will not come in this quarter because they will wait for client budgets to get freezed, which happens in November, December. So in January result, you will hear a lot about long-term structural growth and turnaround in industry and all that. So broadly, this is what my expectation from the quarter.
Okay. Sandip, the tough part is how to look at the stock. I mean, can it still be added to portfolios now after its huge run-up? And do the numbers that you speak of in terms of growth and the margin expansion, I mean, do they justify a fresh entry even now?
Yeah, so see, let me put it this way. If you recall, just 7, 8, 10 days back when Accenture numbers came, this stock was around 2,400. And on, I think, first week of September, it was 2,200. And my view is same that, we are entering a very big structural tech cycle, which will continue for 5 to 7 years, primarily because, cloud transition for large clients cannot happen in 1 or 2 quarters or 4 quarters. So it is a structural growth story. Secondly, if you see, everything which could go right has actually come together after almost, I would say, 20 years for the sector. The local resources for all the companies have been at very high number versus earlier. So you cannot, squeeze them anywhere from, localization concept or from H&V threats and all that. Those threats are behind, those compliance are already in place. Most of these companies have trained all their workforce in new technology, that is digital, in a very big way. Thirdly, the bigger thing is that, if you see what has happened in EPAM and Globant, it is happening, same thing is happening in Indian IT also. Now our digital is 45-50% of the overall revenue for large names, and it is going at 45-50%. So next year, digital proportion will itself become 58%, and in FY23 it will become 70%. So even if growth rate for digital falls from 40% to 20%, still you will see structural acceleration in overall growth rate, because your composition or mix of revenue is tilting towards high growth business rather than low growth. And margin will also improve because now, because of the pandemic, clients will be more receptive to near shore execution or offshore execution, which is margin accretive. So I think everything which could go right for the sector has started going right, and it is not a temporary 1 to 4 quarters thesis. It will be a very long-term structural thing, and people will upfront multiple. In my view, big re-rating in the sector will happen in month of Jan, while every month there will be 6-7% uptick in the sector because of one or other event lined up.
So what is the fair multiple for TCS according to you, considering that it is entering into a high growth period which is likely to last for a few years? And secondly, what have you made of the latest directions coming in from the United States about tightening the visa norm? They are talking about increasing the minimum wages for H-1B, sharpening the definition of specialty occupation, lowering the tenure of visas. What kind of an impact do you expect it to have on the Indian IT industry, considering it's going to be effective immediately?
So see, absolutely it is sentimentally negative to hear, but we have to also acknowledge the fact that India is the world's factory of outsourcing. We are the only country where there are resources which can be provided for software execution for IT services. So, you can increase the cost of execution a little bit, but you cannot, stop taking the services of that industry or that factory. So in my view, for us, little bit cost increase will be there definitely when this kind of norms come, and these are very relevant just before election. It has always happened in last 24 years. Every election I have seen there are some cost increases which come, which is fine, because there are some political comments also involved in that. So I think, from that perspective, sentimentally slightly negative, but in an upturn, when there is an upturn in the industry, when there are such big levers like cloud adoption accelerating, digital adoption accelerating, I think, they will be taken care of, number one. Number two, as far as your question to multiple comes, I think the last 10-year average price earning multiple should now be 40% higher. So it should, the multiple which investors should assign to the sector now should be 40 to 50% higher than the last 10-year average at least. Because when you are getting into upcycle, the first you will not get all the upside in first year. First year will be a year where some revenue growth will come, some margin improvement will happen, but that continues for 3, 4, 5 years. So obviously the best way to capture is that, upfront the multiple rather than wait for actual numbers. So I believe this sector will trade at 40-50% premium to its higher historical average multiples. So I think, our TCS should trade at, 35 to 40 times, somewhere between that. Our Infosys should trade at between 27 to 32 times or 35 times. And HCL Techem should be around 20 to 25 times. That is what my sense is.
Wow, 30, 35 times. I remember when I started my career way back in 2005-06, that's when these IT giants used to trade at those multiples. Great talking to you. Thank you, Sandip, so much for taking out the time and explaining the market's excitement around some of these IT giants, including, of course, TCS, which is reporting numbers today. So we'll watch out for all the action. And of course, the management is going to be here with us live tomorrow morning as well. All the earnings action, of course.